Hello, I'm Dr. Darya Shirokova, and today I have the second webinar of the series, Houston, We Have a Solution. Today, we have our guest, Miguel Nakhle, who is Executive Vice President of Compass Lexicon, and he's based in Houston. So, Miguel, tell us, how did you decide to become an expert, damages expert, and also how did you end up in Houston?
Yeah, I will tell you. But first, thank you, Daria, for the invitation. It's a pleasure to be here following Enrique's first session. I'm very happy and welcome everybody. We are here in the offices of Compass Lexicon in Houston, Texas. And yeah, I've been doing this work for almost 22 years now. I started in 2003 in Buenos Aires, Argentina, doing the first investor state cases against that many investors brought against the government of Argentina. And then moving on to the rest of Latin America, Eastern Europe, and I've been doing that almost exclusively for the vast majority of my career. I'm an economist by trade. I studied in Argentina. I have a master's in finance, and I did my MBA here in Rice University in Houston. I have worked on various capacities in over like 50 international arbitration cases, and I have been testifying in arbitrations for the last 8 years or so in about 25 cases.
So how did you end up in Houston?
Well, it's an interesting story. Almost everything in Houston is energy related. I started, as I said, in Argentina, then moved to New York, and then trying to match with my wife's career in the oil industry as well. We decided to move to Houston, which has been fantastic because it's a city that combines, in my view, great quality of living, but as many career opportunities. In energy, but also in other sectors.
So we will try to make today's webinar as informational as possible. And Miguel and I prepared a list of questions which we hope you will find interesting. So Miguel, can you explain in which types of cases did you work, which types of claims have you seen, and a little bit more about your expertise?
Sure. I have done as I said, over like 50 cases, both investor state and commercial arbitrations. Earlier in my career, I started with investor state arbitrations, very much, energy focused, as we said, like being in Houston, the energy capital of the world. I've done a significant number of cases within the energy industry, including, for example, Total versus Argentina, which was a case that comprised oil and gas, power generation, natural gas transmission, and transportation. It was a very complex and long case, and several others in the energy industry. And then slowly started to do more of commercial cases as well in the industry, related to contracts. There's as we know, in the energy industry, it's very common to have very substantial initial investments that are tied to long-term contracts, right? And it's very common to see that over time, sometimes these contracts will have faced some kind of issue between the parties, and therefore that gives
you like more investment or commercial?
They have their own challenges. I think I've learned to like commercial arbitration as well. Investor has been most of my early career, as I said, but I like the challenge of in a commercial case. Now you have to look at the contract, and there are specific clauses that the parties may have agreed upon, and you have to abide by those. So I think it's very interesting to kind of have to change your mindset a little bit, even though the tools we as experts use are essentially the same.
Okay, now let's talk about the tools. How do you approach the assessment of damages?
Yeah, so the first thing we do, and again, having done this, and I do this all the time, so we have like a methodology, and for us, the approach that I follow is to start with very clear understanding of the facts of the case. We are normally approached by counsel when already there has been a discussion with the client, either claimants or respondent in the arbitration. Sometimes the arbitration is well advanced, sometimes it hasn't started yet, but we get this, I like to get the understanding of the facts really, really well. And then once we get the facts, understand the claims, right? We can't assess damages if we don't understand what the claims are, because the claims are defined by the lawyers and the clients, and then we need to understand, okay, now that this has been claimed, this is the breach of the contract, or this is the breach of treaty, how do we assess compensation? And then the next step is, what is the standard that we're going to use, right? What are we trying to achieve with that compensation? And it seems like a simple question, but it has some complexity to it. The one that I would say that we use the most is the full reparation standard. So essentially the horse of factory case that we are looking to assess as the quantum experts, the compensation that would wipe out the impact of the breach, right? That would put the claimant in the same position the claimant would be in the absence of the breaches. That's the most common. There are others, particularly in commercial cases, the lawyers may argue for a restitution approach, or we want to effectively undo the contract, so assume the contract had never happened. What would be the compensation to put the claimant in that position? But normally, it's as I said, the full reparation, and that requires, which is the next step, is build this counterfactual, right? The but-for scenario, which is sometimes it's not very intuitive, because the claimants sometimes tend to think about this, or the respondent as well, as a before and after. Right? So it's before the breach, after the breach. The way we think about it, and we need to think about it, is with and without the breach. And that's different, because now we are building a world that may be impacted by a lot of factors that would have happened anyway, that we need to account for.
Other factors.
Other factors, external factors that are not related to the particular breach that we're claiming, that we need to account for. And therefore, we need to create this but-for scenario. And tied to the but-for scenario is the issue of causation, right? What would have happened, like, without the breach? Is the breach the cause of the damages that we are claiming?
But isn't causation more like something which the tribunal should do, to install the causation between the facts and what happened to the investment, for instance, or you as experts also take it into account?
Yeah, that's a very interesting point, because I think it goes both ways. So there's the first level of causation, which is between the facts and the claims per se. That's, as you say, is mostly determined by the tribunals, and the lawyers will argue that part. But then there's the issue between the claims per se and the damages that result from the claims. I mean, which is something that we tend to deal with more. Not always, it depends on the case, but sometimes it's a legal point that needs to be made by the lawyers, in which case we may take an instruction, and that's perfectly fine. And sometimes it's part of the analysis itself. So just to give you an example, I was recently involved in a case of a gold mine that it was actually an energy case, really, because it was a commercial case about the supply of the generators that you need to run the processing plant at the mine. And the whole discussion with the other expert was about mitigation, right? So let's say you don't get the generators that you were promised according to the contract. Now, what did the company do? And what the company could have done? Should the company mitigate? They could have done
damages,
this,
right?
Exactly. So that again that goes to the causation, because you may establish the claim. Yes, there is a breach of the contract, but was that breach of the contract the cause of the damages, or the claimant should have done something different to avoid or mitigate lower those damages? So that discussion fell into our realm, but there are other times that it doesn't. So this is always discussed with counsel, and depending on the nature of of the dispute, we may do it ourselves or rely on their reviews.
Now we should also talk about a very important point, which maybe everyone who talks about damages has heard about, but some people don't really understand what it means. So can you explain what's the fair market value and what are the approaches and then the methods to assess it?
Yes, definitely. The fair market value is essentially a standard of value that is widely used because it's included. I mean, it's used outside arbitration too. It's used in tax disputes.
Outside.
It appears, yeah. The U.S. Supreme Court even has a definition that we normally rely on.
What's the definition?
The definition that I'm not going to repeat it by memory, but it's essentially the price at which property would exchange hands between a willing buyer and a willing seller. And just have a note here, just so I forget, acting at arm's length in an open and unrestricted market. Neither is under compulsion to buy or sell, and they have reasonable knowledge of the facts. So it's a lot of conditions, right? It's kind of like an experiment in a way. Right? It's a hypothetical willing buyer, willing seller. It's an arm's length transaction, right? So they are not related parties. They don't need to buy or sell. They are not under obligation. So a fire sale, for example, if you are under bankruptcy, that would not be fair market value necessarily, right? Depending on the condition always. But you would think, okay, there's an obligation to sell, or we need to sell it because we need to pay the banks, for example. So that price may not be considered under that definition. And the reason why it's so widely used is because it's included in many of the bilateral investment treaties. As you know, in the expropriation clause, it would say if there is an expropriation, then compensation should be equivalent to the fair market value. Some treaties say market value. Tribunals in practice understand that as fair market value. It's commonly understood like that. And then we need to assess that value. What is that price that the parties, in this case, let's say an expropriating state or they expropriated an asset, what is the price that asset would have obtained in this situation? Hypothetical willing buyer, hypothetical willing seller.
And for the energy industry, as we all know, the energy industry is very volatile. So what's the right moment to assess this fair market value in case of energy investments or energy contracts, any other cases?
Yeah, that's a very important topic that is discussed, and that's another parameter that when you assess damages, particularly in, as you say, in the energy industry, and in the case of an expropriation, for example, or any other breach, is the issue of the date of valuation. Right? The date of valuation is nothing else than the date as of which you have to assess the value. What was the value of this asset on X date? That date is the date of valuation. Now, there are particularly in treaty arbitration, starting, I think it was the first ADC versus Hungary case, when the market after the expropriation evolved in a way that would have increased that value, the value of that asset, which was an airport concession, significantly more than what could have been expected when it was taken, right? So there wasn't this concept of, again, going back to the full reparation principle. If you had not expropriated, I would have benefited from that increase in value. And tribunals have found in many cases that if there is an unlawful expropriation, then instead of using the date of the taking as the date of valuation, we can look at the date of the award.
Oh,
right?
interesting.
So that means taking into account all the information that now in hindsight we can see from now being standing here, after the fact. In the case of energy, obviously oil prices, production. Conoco, Phillips versus Venezuela is an interesting case because the tribunal decided that it was okay to look at what happened in the market after. Now, as far as I understand, it's in the award. Conoco argued that they should not be using the production volumes that Venezuela produced from those fields, because Conoco argued that they would have produced higher volumes, right? That they would have managed the fields more efficiently and and produce higher volumes. The tribunal did not side with that, so they went.
That was quite speculative.
Well,
right?
yeah, I mean, I can see it both ways. So you can say, yeah, it's speculative, you don't know. At the same time, it's well, but the asset was taken by the government, so we'll never know. And that's always the issue with but-for scenarios, right? They are always hypothetical by definition. It's counterfactual. So you need to build a scenario of what would have happened. And in the balance of probabilities, does it make sense to assume that would have happened or not? In this case, the tribunal said, no, we're going to use the actual production that that the fields had, and we're going to use the actual prices, which gave a value that was significantly higher than if you were to value the same fields standing in 2007 without knowing what's going to happen later on. So again, data valuation, very important.
What about creeping expropriation?
Yeah, creeping expropriation, again, many cases have dealt with that, and
I hope I didn't say anything wrong.
No, that's fine. It's indirect. The issue with creeping expropriation is that you don't have a clean one measure, right? So it's going little by little. The way we have approached it historically in most cases is, okay, there's going to be a moment of the taking that we can have finally when, for example, just to give you, and I'll throw in the indirect expropriation too. We've worked in cases in which the government of a country started implementing a number of measures that did not necessarily make the business unviable, but it significantly impacted the business. At one point, those measures became so harsh that the investor itself decided to shut down the operation and leave the country. Now, the lawyers argue that those measures accounted to an indirect expropriation because there's a substantial deprivation of value. Now, or whatever standard they want to use, this is always a legal point for us. But the lawyers made a point that by the time the investor left, the value had been destroyed by all these other measures. So the way that we assess damages for is we had to start the but-for scenario much earlier, right? Because we need to wipe out the impact of the measures that took place before even the actual shutting down of the operation.
So from the first measure
From the
taken
first
by
measure.
the
Now,
state.
does that mean that the first measure is the date of valuation? No,
Oh, that's
not necessarily. Not necessarily. We don't need to go back to the first measure and compute the fair market value. And some experts will disagree. And by the way, this is always, of course, my own views, but we don't need to go back and say, okay, what was the value right before the same measure? Because again, as I said at the beginning, we are looking for a counterfactual. We are not looking for a ex ante ex post or before and after. So what we are going to do is go back in time and wipe out as much as we can what would have been the performance of the particular company in the absence of the breaches that are being claimed. Not the rest would have remained the same, but the breaches that are being claimed, right? So that's the exercise that we need to make until the point in which the operations are shut down, and then we can assess the fair market value as of that point. So the way that the damages are going to look like, we're going to have two components. We're going to have a historical damages component, which covers all the period where the creeping expropriation or the different measures started and impacted. And then we are going to have the fair market value, counterfactual fair market value in the absence of the measures that had been affected the asset. Right? So that's a very important point. We get to the point of the actual shutting down of the operations, but what was the value of that, or what would have been the value of that operation, that asset, in the absence of everything else that is also a breach? We need to wipe out everything, right? So it's a challenging exercise, but it is what
that's why you exist, right? The experts to do this challenging exercise. So coming back to this fair market value, what are the methods of assessment, right?
Yeah, fortunately there are methods that are widely accepted by the profession and by tribunals. So that's very good. It wasn't always the case. As I said, the arbitration has evolved, progressed a lot in the last 20 years or more on how to assess this fair market value. And I should start with the discounted cash flow, which most people at least have heard of in the arbitration arena. Discounted cash flow, just to be clear, it's not something that we do in arbitrations. This is a method that is used in valuations and finance in everything else generally, right? It's taught in universities. There are books about it, right? So it's a tool that we bring into the assessment of fair market value in arbitrations, but it's something that is commonly used. Discounted cash flow is essentially based on the principle that the value of any asset is equivalent to the expected cash flows that that asset would generate for the owner going forward, right? So you don't care, the asset may have been fantastic before in the past, but what you're looking at the DCF is always to the future, always to the future, right? That's the first one. You are going, the DCF is effectively forecasting those cash flows, the expected cash flows. It can be during the length of a concession, for example, if we have a limited time period, or it can be forever, right? And there are methods to do that in finance. You do a terminal value, for example, you forecast forever. The business never ends. Now, the trick, of course, is that you're going to be discounting. That's the discounted part of it, right? So you were going to forecast, and then you're going to discount. You're going to bring those back to today. The discount rate will act to, we weigh those cash flows depending on where they are in time. So the farther we are in the future, the more discounted they are going to be. And that is very, I think it's very intuitive to see, because of course, we're going to have a much harder time forecasting what's going to happen in 10 years than next year. So the forecast in 10 years is going to be less reliable than the one next year. So we're going to discount it more. It's going to impact the value less than the forecast of next year.
Okay, let's do this exercise. For instance, we have a concession from, let's say, 2015 to 2045, right?
Yeah.
So 30 years concession. And today there's expropriation. Let's say it's not creeping, just very direct expropriation, which happened 2025, 10 years after the concession, right? So how will we apply this discounted cash flow method to this? Let's say it's a plant, like the brick plant.
Okay.
Expropriation of a brick plant.
Right. So we are standing in 2025. We still have 20 years.
Yeah, 20 years to go.
20 years left.
2024, 2045, 2045.
Yeah, so we still have 20 years of concession. And I think, so great. So the plant was expropriated. A discounted cash flows, we need to, let's say, we need to assess the fair market value of the plant. First question, what's going to happen in 2045, right? So let's start with...
Although we're in an energy industry, no brick plants, let's say it's an oil concession.
Yeah, or we have, just to give you a real life example, we've done a few cases on oil field services. So you have, for example, if you are a natural gas compression company, they provide a service at the field. They will install this very expensive equipment that it's really, in many instances, custom made for the field. So after the fact, all you need to do, it may even have a negative value, since that you need to remove it from the field. Sometimes it's compensated by the value of the equipment itself. So let's say that after 2045, there's nothing else, right? There's no more revenues. The contract is over. You take your equipment and you leave. Now we have 20 years left for the DCF. So the DCF, we need to forecast the cash flows. Cash flows are not profits, right? Cash flows are the inflows of cash into the company. Sometimes they are confused with profits, but technically it's not the same. So if you have investments that you need to make, that's going to impact your cash flows, not necessarily your profits, at least not directly. So we focus on the cash flows. Let's see what revenues that plan is going to make. We were going to forecast the revenues. We're going to forecast the operating costs. We're going to forecast the investments if we need to make an investment. We're going to forecast the taxes that we may need to pay on that. And then we'll end up with the stream of cash flows year by year, 2025, 2026, all the way to 2045. It's going to be a long line. Now, should we add them up? No. We're going to discount them first. We're going to use a discount rate to bring them back.
So every element is discounted first.
Yes.
Before being added up.
Exactly. Every element. And it's going to be discounted by a rate that we can talk about it is very interesting for me, which is the weighted average cost of capital many times, or the cost of equity. There are different rates that you can use, which is very, very important. The rate that you use to discount can create significant differences in value. And it's normally one of the issues that the experts debate more, because 2 points more on the discount rate may lower your value by a significant percentage.
Yes.
So we are going to discuss what is the appropriate rate that we should, and there's the risk is involved, and we can talk about it later. But before adding up, you discount, and then that's going to be your fair market value, let's say, using a discounted cash flow approach. Very, very high level, right? But that's it. And the good thing, going back to your example, you already have 10 years of operation.
Yes. That's a good thing, right?
That's a good thing. It's always a good thing. Is it absolutely necessary? In my view, no, I wouldn't make an absolute statement like that. There are many cases in which you may have no operation, or you may have just a little bit of operation, but there are other elements that allow you to have a robust forecast, right? You may have it, for example, going to energy, a power plant. You have a PPA, right? You have a power purchase agreement that someone is off-taking that power from you at the set price, you know, the adjustment clauses. So you can create that forecast fairly easily, let's say, quote unquote. Right? So it's always complications, but it's going to give you a good measure of, okay, how are these prices going to evolve in the future? Well, I know it's in the contract, right? It's in the contract. The cost, you may have already an idea. If it's a solar plant, for example, solar plants are always dispatched because they're at the bottom of the dispatch. They're always dispatched first, right? They have variable cost zero, so they tend to be dispatched first. So you know, whatever you generate is going to be sold. So you see, like these kind of elements, if you don't have a history of operations, can be very useful. In your example, you have 10 years, which you're definitely going to use.
Yes, it's a good example, right? We already have 10 years and we have 20 years to go, so it's quite easy. What about other methods? So when for instance, you cannot apply this discounted cash flow, what other methods?
Yeah, there are other methods which in many instances we apply in conjunction with the discounted cash flow. The one that is always kind of second to discounted cash flow is the market method, so the market approach, relative valuation. Effectively is looking at other assets. Remember, we are trying to get to the price, right? To the price at which this particular asset will exchange hands between a willing buyer and a willing seller. So one way to do this is, instead of doing a DCF, we look at what other people are paying for similar assets. Now, of course, it's very hard to find a perfect comparable. So there are these ratios called multiples. Right, and the easiest way to think about this is when you're looking for a house and you want to know if the house is properly priced. Usually, your realtor will give you some other houses that have been sold in the area, and you will have a price per square foot, right? Price per square feet. That price, that's the same thing you can do with companies or with assets, right? Now, it's not going to be price per square foot, but it's going to be, for example, the enterprise value divided by the EBITDA, by the profitability, right? So you can scale the what you see in the market and bring it to your asset. Just as a way of an anecdote, when I first started working on this, and we had these very complex DCF models, right? It took us forever, very long, a lot of long nights to put them together. And then one time we presented to the client, and I was a junior associate back then, and we explained to them, and the client is looking at, it's a finance person, and they look at the value that results from it, and they say, yeah, that's about 7 times EBITDA. It sounds reasonable. So without looking at everything else, is 7 times, and that really stuck with me. It's like, is 7 times EBITDA, that's reasonable, right? So the person already, without knowing anything about the very complex model, they could understand that the result made sense. Why? Because companies in the sector are traded at 7 times EBITDA, or a similar company was sold at 7 times EBITDA. See, so it gives you already a sense of whether the number you are getting is appropriate. So that's relative valuation. Sometimes we use stock prices if the company trades, very useful. So all about like market approach. And then the last one that I would mention is the cost approach, right? Which sometimes is confused with sunk cost. It's not necessarily the same. Technically speaking, the cost approach will be the replacement cost. So if I have to build the same asset, how much it will cost me? In many instances, that's impossible, right? Because you have a concession. Let's say you have an oil concession in.
It's quite unique, right? Because if you have different countries,
sometimes it's a plant, right? It's a power plant, or it's a whatever it is you need to do. You may rely on that, but now if it's a power plant, then what about the PPA, right? That the power plant has, so that's unique, right? So you can use that method. But people look at it in some instances in oil and gas, in particular, and in mining, when you have this very, very early stage development. For example, you have resources but not yet reserves. So sometimes the valuation standards tell you that you should be using a cost approach, right? How much you spend on getting to that point. That's what people may transact for in a way, right? So we have really, it's very difficult to know what the cash flows are going to be. We are too early. Let's look at what you already invested, and that will give us an idea of the value. But again, it's a case by case basis.
You've mentioned the sunk costs. So what's the sunk costs? Do you ever use them, or it's something which is not really used
No, sometimes you use them. Yeah, the sunk cost effect, what we mean by sunk cost, or it's normally understood, is how much it costs someone to build that asset.
So what they already spent.
What they already spent. So it's very common in mining or oil and gas. These are all my exploration costs. And so far I've spent $50 million, right? It, as a measure of fair market value, it may be completely off, because for both ways, right? Like you may have spent $500 million and you don't have nothing to show for, because whatever you did was not successful, right? In an exploration. So no one is going to be willing, going back to the willing buyer, willing seller approach, to willing to pay for that asset what you invested. Now, the opposite is also true, right? So if you spend, let's say, $50 million, but you strike gold, now is the $50 million a fair market value indicator? No, because now you strike gold, so it's very different, right? So now someone's going to be willing to pay you more than that. So again, it's a measure that tribunals, mostly in the past, have resorted to when they think it's early stage, speculative. Okay, what you're effectively doing is putting the investor back, assuming that the investment never happened, right? So effectively giving back the invested amounts and kind of wiping out the investment itself more than the counterfactual.
I see that we already have questions. Do you want to answer questions from the audience?
Yes, of course.
Well, we have chat and questions. Let's start with the question. So, Gabriel Morales. Okay. Thank you, Gabriel, for your question. I will read it and Miguel will answer. Okay. The Conoco case in Venezuela raises a question for me. What method is used when the assets whose value must be determined generates profitability? Is the profitability taken into account to determine its value?
Yes, definitely. And that's why when I mentioned the DCF method, I focus on cash flows. The profitability, for the most part, a profitable business will likely be a cash flow positive business. And 100% if the is the profitability taken into account to determine its values? Definitely it is. It is taken into account because it's gonna give you, when you forecast, again, I'm going back to what I said before in terms of the past profitability. A business may have been very profitable in the past.
Exactly.
But may not, looking forward, may not be as profitable. And we know plenty of companies, right, that have gone down.
Not taking into account their geopolitical conditions, right?
Yeah. It's an industry, business itself,
okay.
Right? You sell a product that people no longer want. That's fine. But if the company is going to continue doing what has been doing and there's no other elements, I would like say that the past performance will not inform what's going to happen, that profitability is going to be very valuable to decide if the value, because it's in a DCF is going to be accounted for.
Oh, for instance, an example, something which nobody wants anymore, like the normal phones, right?
Yeah.
For instance, the company, I think it was Alcatel, one of the examples, the French company which used to do this simple mobile phones, and now with all the AI, the iPhones, and the etc. So, how would you, for instance, evaluate the price of this business?
Yeah. So
which methods will you use?
That's a good, because you still use a DCF. You still use a DCF, or you can use the other methods, but the way you are going to build the DCF, right? It would be a mistake to say, oh, because the company has sold, had this level of revenues in the last 20 years, that will continue. When you know that the market has changed and nobody wants those products anymore. Or BlackBerry, if you remember, back in the day, they were all over the place. Now you can't find it. So you may have a forecast that is going to be different from the past performance, right? So now the past performance, you have to look at it with a little bit more care, because it may not inform what's going forward. Again, always the principle is investors or anyone, buyers and sellers, sell and buy based on expected performance, right? Past performance, to the extent it informs the expected performance, is very useful. If it doesn't, we did a case, just to, again, real life example, 2003, 2004, Telefonica versus Argentina. I still remember looking at it back in 2003, 2004, right? Mobile phones were there, but not very common. And you could see,
I didn't even have a mobile phone in 2003.
Exactly. It's not very common.
Back in Russia.
But they had in their forecast for the DCF, you could see the landline revenues going down. And we were like, it was so surprising to see that, because for us, landline will always exist, right? And now I don't have a landline in my office here.
Me neither.
Right? So it almost completely disappeared. So that's the way, when you do a forecast, you can't ignore that, those market shifts.
Let's, I see we have more, questions. Let me see. So coming back to the example of our plant concession for 30 years. So one of our guests is asking, on this subject, how do you forecast the price of the goods by 2045, which will have impact in your cash flow? For example, natural gas prices are volatile. Actually, that's one of the questions I wanted to ask as well. So how should global energy price volatility be factored into the damages assessment? Thank you for your question, Mauricio.
No, it's a good question, and I think it's a good way to also like demystify this thing of this idea that you have to forecast. How do you know what prices are going to be in 2045, right? Which is this question. Nobody knows. Prices are volatile, yes, of commodities, but also of many things, and people still buy and sell companies. And people still use the discounted cash flow and do the best forecast they can with the information they have as of the date in which they are transacting, right? So we do the exact same thing. Now, do we need to be 100% sure that the price is going to be what we forecast today? No, we accept, as economists in general, we accept that uncertainty. We price it. Right? We price the risk into the valuation. We are going to set up a forecast just to take you like a step by step, right? If we need to do, let's say it's an oil and gas concession, right? You're going to be forecasting producing oil and gas. You're going to be selling it to the market. Now, believe it or not, we talk about like the bad thing, like volatility, but on the other hand, there are positive elements when you need to forecast something like that. Why? It's a commodity. You have prices that are being traded in open markets, right? You can look at the Henry Hub, you can look at the European prices, you know where prices are being traded for. You have futures, the price is being the commodities being sold and bought for today for future delivery. So you know what the prices are going to be transacted, and then you have plenty of market forecasts, IMF forecasts that you can use.
Mhm.
That will normally cover your first 5 to 10 years, right?
Mhm.
After that, what as a practitioner we do, we continue those. We just continue, let's say, by inflation, or we keep them constant, right? It's the best estimate. Nobody knows, and that's okay. Now, how do we price that? And with, as he said, 2045 is going to be heavily discounted, right? That's the pricing, right? It's not going to be the same. So may I be wrong about the 2045 price? Very likely.
Well, we'll do another webinar in
We know in
2045.
years, but it doesn't matter because I'm transacting today, and that price is going to be heavily discounted to today. So the discount rate accomplishes that function of heavy pricing in the risk of the things that I'm forecasting that I don't know.
Okay, another question. We have a lot of questions. Thank you so much, everybody. Do you also consider the cost and market approach? If so, how? Does it depend whether you are on the claimant or respondent side?
Yeah. Well, I think we touched upon briefly on the cost and market approach. Market approach, going back, is normally understood as relative valuation. Look at transactions in the market. We, in many instances, look at also stock prices that we can rely on if the company trades, for example. And the cost approach is the replacement cost, or sometimes the book value. We didn't talk about this, but the book value is, if you open a financial statement of any company, it will tell you assets and there's going to be a number. So it's very tempting to think that that's the fair market value, and generally it's not. That reflects historical cost. But sometimes we use it. It again depends on the case. It really does not, go to the second part of the question. It doesn't depend on whether you are respondent on claimant side. You know, as we are independent experts, so our duty is always with the tribunal. We're going to be cross-examined heavily, and so we know, and that's, you know, when you have done this for a long time and you expect to continue to do this for a long time, you protect your reputation very much. So it really doesn't depend on the one side or the other. Of course, we will have differences with the other experts. Sometimes the differences are on the assumptions. It's not really on the method. It's what are the assumptions? What is the claim? Maybe the legal instructions are different, right? But the methods are fairly standard.
Do you think experts should be stress resistant?
Should be what?
Stress resistant.
Well,
to go through all these cross-examinations.
Yeah, you can use it.
One more question by Enrique. Thank you, Enrique. What has been the most challenging case in which Miguel had to assess damages, and why was it so difficult? Of course, if you can answer this question.
Yeah, there are many that come to mind. I think I want to go back to, you know, kind of like reveal my age and everything. But when I started doing this back in 2003, this was a case that I worked on the entire case. I was not a testifying expert, but I worked from the beginning until the very end. And this was the AES versus Argentina case. The award came out like a few months ago. It was a very positive award, extremely complex case. The parties suspended the case for many years. So imagine a case that goes for over 22 years. And now the vast majority, and this is all it's in the award, the vast majority of the claims were historical. So now we have to go back in time and assess the impact of all these different regulations that the government had enacted over on the impact on the investment for the last 20 years. It's a very complex case. Fortunately, the tribunal was able to understand the different issues, and it didn't side on everything, but still, I think it was pretty reasonable. The way they approached it, I think, was very reasonable. And anyway, it was pretty complex. It's a power generation case, but there were issues related to the natural gas market that are discussed in the award as well. So over 20 years, we had to go back to the initial reports that we had put together, which did not even have paragraph numbers at the time. So it's a long evolution in the way we now produce our reports since then. Yeah.
And you have more questions.
Oh,
you're so popular, Miguel. Oh, doing good job. So, questions by Daniel. How does an arbitral tribunal account for contributory fault by the investor when assessing damages? I would like the answer to be both substantial fault and partial. I think that's he means partial fault. And secondly, so Daniel is working on an article on balance between transparency, trying to find it. Sorry. Transparency and confidentiality. And the question bothering me remains the role transparency plays in arbitration, particularly regard to damages, claims, and awards. Can be answered at the end of the webinar. So we'll try to answer all the questions right now. Do you want to answer any of these
questions? I think that the first one, of course, we are always cognizant of not stepping into the lawyers.
To the arbitrators, yes, because there are questions from lawyers and arbitrators,
yes,
right?
Yes, but what I would say is that there were cases, and I think it's going back, pretty sure it's a Total versus Argentina case, when if you look at the award, for example, the claim was effectively for the difference between this but for fair market value that we computed, kind of counterfactual, right? And the price at which Total had effectively sold the assets. So if you look at the award, I think the tribunal decided that that price at which the company effectively sold the assets was too low, right? So normally they should have, or one could argue that they should have granted the difference between the two numbers, right? So we have a counterfactual without the measures. They effectively sold the company for this amount. The difference is your damage. The tribunal said, well, maybe that amount is too low. Like you had other reasons to sell the assets, right? So in a way, you are contributing to that difference. So instead of using that actual selling price of the asset, they relied on some DCF model we had put together, which was a little bit higher than that. So I think in a way, for us, it's an issue of mostly, as I said, mitigation, whether we should account it for, but I know that there's a lot of legal aspects that we normally we don't touch upon.
Coming back to the risks, so we discussed the volatility of energy prices, right? The question I really like is the political risk, right? Yes. Because sometimes investors go to the places where they know that it will not be easy, or these countries have already showed themselves as not reliable in some respect. So how do you assess these political risks? And I've heard that there are some kind of numbers indicating countries. So can you talk more about this?
Yeah. Okay, this is again an issue where experts tend to disagree on, at least from past experience. But it's very much studied, and is the issue of what we call the country risk premium. Because as you said, and trying to keep it within the energy sector, oil and gas, for example, is not always found, in the most stable
paradisiac places.
Yeah. So companies have to go where the resources are. The same thing with mining and any other natural resources, right? So there's going to be a risk involved in investing there, and we need to account for it when we do evaluation, and we do it through the country risk premium. The country risk premium, there are different ways. Many people say there are other ways, but one of the most standard one is to include it within the discount rate. Remember that we talked about the rate that you use to bring those. Now, the higher that discount rate, the lower the value, right? Because you are going to be discounting heavier those. Yeah. The country risk premium adds to the discount rate. So if we have a discount rate of, let's say, 10% without country risk premium, when you add the country risk premium, that may become 12%, 13%, 15%, which means the whole value is going to come down. See? So we are accounting for the political risk by this adding this country risk premium in the discount rate. Now, how do we assess that country risk premium? There's a lot of different theories. In many cases, we use what's called the MB spread. So effectively, if you look at the return of a treasury bond here in the US, which could be, for now, it's like 4%, 3-4%, and then you find a bond issued by, let's say, Venezuela, the bond that is issued by Venezuela will normally pay significantly more. Why? Because it's riskier, right? Investors require a higher rate of return on a riskier bond. That differential between the yields of the bond, that is usually used in the discount rate to assess the country risk. There are, again, many instances in which that may not be the appropriate one. Your company may be less exposed to it. And in going back to the ConocoPhillips case, and you see it in the award, there's this discussion, right? Is Conoco exposed to the full country risk of Venezuela, or because it's an oil and gas extraction, it's an oil and gas field that's going to be exporting the oil, selling its products in dollars, you're not exposed to currency fluctuations, you're not that exposed to inflation inside. So should the asset be valued accounting for all the risk or partial risk, and there are
so the index will be different depending, for instance, whether the contract is a concession which pays with money, local currency, for instance, or if you have the PSA, the production sharing agreement, when the investor gets its profit by a share of the energy resources, right? So the risk will be different.
Yes, I mean, in principle, yes. I mean, I would argue that should be accounted for. Of course, not every expert will agree, and that's where there's going to be discussion, debate about that. And again, anyone can see it in any award, and you can see the opposing sides. And one side in that case argued that exactly what you said. There's a production sharing agreement. There are other safeguards that protect the investor, and the other side said, well, that doesn't matter, right? Because you are still exposed. So that's a big and going back to the impact, it can be very substantial. Right? It's not the same you may have the same string of cash flows with a discount rate that is 10% versus 15%, and the value is going to be much lower.
The value will be different. So we have around 7 minutes left. Let's go to less intellectual but more pleasant part of our discussion.
It's very pleasant.
Less I would say mentally consuming, right? So what are your favorite places to bring a client in Houston?
Well, I guess
clients from outside of Houston.
From outside
Argentinian clients.
Right. Well, Argentinian clients, I would never bring to an Argentinian restaurant because there's nothing better than a good parrillada in Argentina. I wouldn't even try. This is a short anecdote, but when I was living in New York in 2005, I think for a while I had to be there. And we were finishing the project, and the managing director or the expert was like, oh yeah, you've done such a great job, and I know you are from Argentina, so let me take you to a steakhouse. And I didn't know what a steakhouse was, and the first thing I realized that was not an actual parrillada from Argentina. The fact that you're going to get one piece of meat, normally overcooked, so no steakhouse. But no, we like here in downtown. Our office is in downtown, and we are close to Sochi, which is the Mexican restaurant here at the Marriott Marquis from the Oaxaca region in Mexico. Very, very good. So we would normally go there. And then if the one recommendation that I would have, not necessarily for clients, but for people that live in Houston that may be watching this, I live in Katy, in the west side of Houston, in the suburbs, and now we have what's called the Asian town of Katy. It's an area, it's very, very nice to go with Korean restaurant, Japanese, Chinese, one next to the other. There's even a claw machine place that my kids love to go. You can grab your stuffed animals from there. It's very, very, I think it's very cool that people may not be aware if you are not in the area.
So no Argentinian restaurants in
Go
Houston.
to Argentina.
Okay, so we have 5 minutes left and last chance for people to ask questions. Does anybody want to ask questions? See, we have a lot of audience today, which is great. Okay, seems like there are no questions. Thank you so much, Miguel. That was great. I've learned a lot. It was really interesting, and you have a passion for damages and calculation of damages, which is great. Oh, we have a question.
Okay.
Or probably comment. Nice to hear Miguel's experience. It was very informative. Thank you. Thank you so much. Everybody's thanking us, which is great. We are happy that you're happy. And thank you, Miguel, once more time. Thank you to Compass Lexicon for hosting us. And see you next time.
Thank you.
Thank you.